people were always asking me because, again, they hear about this product like through the grapevine. And to your point, like it sounds great. They wish they would have known about it sooner. But there's no information about it. So, and I know it's because that lenders and real estate agents, they gatekeep it.
Hey, Joe McCall here. Have you ever wondered how to get government funding for your first investment property? Well, we're going to reveal some secret hacks on this podcast today, and I have a special guest. His name is Matt Piccaro, and we're going to be talking all about this stuff. This guy is an expert at this strategy of using government money to buy your first investment property. It's a topic, it's a subject, it's a program that very few people know anything about. We're going to spill the beans on this podcast, so you want to stay and pay attention and listen, get some pen and paper out because you're going to start wanting to take notes. Okay, so first of all, this podcast is brought to you by simplelandkit.com. If you go to simplelandkit.com, this is my land flippers toolkit. It gets you'll get all of my checklists, my contracts, my seller scripts. I just did a video a little bit ago on my YouTube channel where I actually called some sellers live and I walked through the realtor script I use with realtors. You can get all of that information, my direct mail, swipe file, contracts, etc. It's all free. Just go to simplelandkit.com and check that out. I want to jump right into this podcast with Matt because this is very interesting. We met at a mastermind a couple weeks ago and I was talking to Matt. A mutual friend introduced us and I said, Matt, this would be really cool to talk about because there's a lot of people listening to this show that are looking to buy some investment property, not necessarily land, but houses or multifamilies or something like that. And they're wondering, where on earth am I going to get the money from? Or they're wondering, where on earth am I going to get the 20, 25% that they think they need for a down payment? Maybe they're just getting started. So I was talking to Matt about this and I was thinking, this would be great for my audience because these are some secret loopholes. And that's kind of, they're not secret, not until you know about them, but these are really incredibly powerful programs that the government has to help you, the investor, buy your first investment property. So Matt Piccaro, how are you?
Good, Joe. Thanks for having me, man. I'm glad to be here. Big fan of you. Been following you for a little while now. So
thanks, man.
Glad to finally jump on. But what an intro. And I think you pretty much nailed everything in terms of the fact that this isn't really talked about much, but it is something that's going to allow people to really carve their way into the game if they're just starting out, especially with the crazy market and the crazy climate we're seeing right now.
Well, yeah, this is something I've not heard of before. And when you were telling me about it, again, I was thinking this would be cool. So first, let's talk about yourself a little bit, Matt. How'd you get started in the real estate game?
Yeah, so grew up in a blue collar family, and the word investing never came up. I don't think it existed in my vocabulary up until probably I got out of college and started learning a little bit about it myself. But, I was always kind of that person that always knew there was a better way. I always kind of looked at the world, like always as a contrarian. I would see people do things and think I could do that, right? And the same kind of happened to me with money, right? From a very young age, money was very volatile in my house, and it caused a lot of the stress and a lot of the emotion. And at a very young age, when your parents are talking about money the way they were, it kind of subconsciously puts you in this zone where you're constantly chasing it or just trying to learn, like, is this the root of all evil? Is this the root of all good? You're trying to figure that out from a really young age. So that stuck with me. And, my parents had their own business, small construction business. And, my dad saw a lot of ups and downs with the business. It was just him, and my mom pretty much running the business together. A lot of ups and downs financially. When times were good, they were good. But when they were bad, they were bad too. Everything from, eating pasta every night to electric getting cut off sometimes, that type of thing. So they told me, go to school, go to college, get a degree, work in New York City, and a paycheck every week is to them that's what they were always reaching for, right? That was stability to them. They were like, we picked this life of having our own business, but that's not the way. The way is working for someone else, never having to worry about, where your paycheck's coming from every week. And so I did that. I did exactly that. I went to college. I went for electrical engineering. It's funny, I picked electrical engineering because going back to the money thing we were talking about, I was so focused on money and and the sensitivity of it, that when my guidance counselor in high school asked me what I wanted to do, I literally just said, well, what makes the most money in 4 years? I said, I'm not going to be a doctor. I'm not going to be a lawyer. I'm not smart enough for that. But, in 4 years degree, what can I get? And she mentioned engineering. And I was like, all right, well, I'm terrible at math, ironically, but I'm really good at science. So let me go after it. So I did. Got into a college, did it in 4 years by the skin of my teeth, and was lucky enough to get into the corporate construction engineering world in New York City, and all during the midst
about
of
this, didn't we?
Yeah, yep, we did, and all during the midst of the 2008 crisis and everything. I was still lucky and fortunate enough to get a job, but very quickly did I realize that this is not it either. So I think I was probably there for about a week until I realized that no, people don't get rich from this either, but I didn't know how. And like many people, probably many people watching this, listening to this right now, I was actually walking down the street in Manhattan one day at one of my lunch breaks, and obviously always feeling disheveled and frustrated on what to do next. And there's guys in New York City that like sell books on the street, like used books. It's like a hustle in New York City. And I saw Rich Dad Poor Dad on the table and a couple other books right next to it, all the Robert Kiyosaki books. And I had always heard about it. This was probably 2008, 2009, maybe. And, I was looking down at the books and I'm like, I've heard about it before. And I just I don't know what it was in that moment, but I said, let me pick this up. And I picked it up, and I bought all the books. They were used. I bought them all for like maybe $5 or something. And I remember I was going to Five Guys and I remember it for a very specific reason. I don't know if you've ever been to Five Guys, but they give you the giant bag of fries. And I was so enthralled with the book that I sat down with my big bag of fries. And I just remember sitting in my entire lunch break and being so enthralled with Rich Dad Poor Dad that I ate that entire bag of fries. So,
wow.
Yeah. And if you know how big that bag of fries is. So, but I think the whole point of that was that book, for a kid that grew up in a very blue collar environment where investing was never spoken about, where W-2 was put on a pedestal, it changed my life, and it changed my whole view of the world. And that really put me on my path to trying to figure this game out.
Awesome. That's a cool story.
Thanks.
Did you eat the hamburger and the fries all together?
Oh yeah, no, the hamburger was smashed too. Absolutely. I'm a big eater. So
that we used to, those of you listening, I used to do the same thing that Matt did. I worked for large construction companies, traveling all around the country, building huge hotels, hospitals, power plants, just a ton of different projects. I built like 3 different large aquatic centers, pools.
Interesting.
And the entire facilities all around them. But anyway, yeah. All right. So you got interested in real estate. You quit your job shortly after. What kind of real estate were you doing when you finally left your job?
So great thing. So I actually didn't quit my job shortly after. I actually just quit my job recently, though, officially. My engineering career, I'll say. I didn't really, my job became less and less of a job over the years. As an engineer, I had a lot of flexibility with consulting and stuff like that. But very recently, I actually left that. But no, I was working my way through it while I was working my job. So really, the Rich Dad Poor Dad book turned into a slew of all different business ideas and trying to find different ways to make money. Because I read the book, right? And I was like, okay, I understand the idea of having a business, having assets, exchanging value for money versus time for money. But like real estate, to me, obviously they mention real estate a ton in the book. But to me, in New York, where I lived in Long Island, New York, right outside of New York City, one of the highest cost of living places in the United States, highest property taxes in the nation. The idea of owning multiple houses, let alone one house, seemed impossible. So I kind of put that a little bit on the back burner. I was like, real estate's for like rich old dudes with big bank accounts and big 401ks. Like it's not for 23, 24-year-old me. So I tried a bunch of different business ventures and things and, tried, I don't know, stock trading, e-commerce, whatever it is. It was always kind of had a side hustle, right? That was always my thing. And then eventually I was listening to a podcast and heard about some guy talking about how you can invest in real estate with no money, low money type of thing. And he was talking about wholesaling. So I kind of went down that road and started learning more about wholesaling. And I went pretty deep on it. I tried a lot of different strategies. I was doing it locally. I was trying to do it while I had my full-time job, commuting 3 hours a day to New York City and back. And really, I think the thing for me was like, I didn't have a lot of time and I didn't have a lot of money. And with wholesaling, you kind of need one or the other. Or if you're doing a combination of both, you got to be really savvy and really just be to it. And I think looking back, I know the things I did wrong with it, but I tried and struggled with it for a couple of years. But I still, the seed was already planted at that point, but I just couldn't stand not figuring it out. So again, I always knew there was a better way to things, and I would just kept turning over every stone, trying different strategies, looking up different courses, videos, whatever I can get my hands on. It wasn't until I joined my local RIA and eventually took the lady that ran it, this lady Melissa, to the side one day and was really frustrated, really kind of at my wit's end. It was getting to the point where like my family was making fun of me, my friends were making fun of me, my girlfriend, now wife, but girlfriend at the time, was kind of rolling her eyes, being like, what do you like? You have you have a good job in New York City, you're working for a big construction company, you got great benefits. Like, what's the rub, man? And I just couldn't stand to like let this defeat me. So I pull this lady Melissa to the side. I'm like, listen, Melissa, I got, a couple grand saved to my name, maybe 10, 15 grand in my bank account. I really don't have much. I've tried the wholesaling thing. I don't know what to do. If you were in my position, you could do this all over again, what would you do? Obviously, knowing being here in New York. And that's when she dropped it on me. She said, I would use something called the FHA 203K loan to buy your first house if you don't have a house yet. And I had never heard of that before. I'm like, okay, well, what's that? She's like, FHA, you're familiar with that? I said, yeah, it's a government-backed program, right? She said, well, since it's government-backed, it allows, it's subsidized. So it requires you to put only 3.5% down. I said, okay, great. The 203K version, though, is their renovation program. So what that allows you to also do is get all the money to renovate a house. It allows you to purchase as-is properties, foreclosure properties, anything that typically was only reserved for cash buyers, you now have access to, because you can buy the property subject to the fact that you're going to be repairing it and fixing it up and holding it longer term. She said, but what I would do, though, is combine it with house hacking and the BRRRR strategy. So essentially what you'll do is, in New York and Long Island, basements are very popular. So basically, she said, buy the house. The only caveat is you have to own or occupy it. I didn't have a house yet at the time, but the owner occupancy rule is only a year from the closing date. So she said, listen, you do it temporarily, you get the house, buy a fixer up or buy something that's really distressed, a foreclosure. Foreclosures were big at the time. Live in the basement, rent out the upstairs to pay the mortgage off. But then most importantly, build some equity into the deal, like you're doing a fix and flip. And then what you can do is take that equity, use that new equity plus your new bankability plus your new experience to go raise private capital, go repeat the process and go do it over again. So lo and behold, she blew my mind, number one, because I had never heard of this. Kind of to your point, you haven't heard of this and you've been in the game a long time and you know your stuff. So, it was mind blowing to me, but I'm so glad she told me about it. But what was crazy about it, though, was I went home and looked it up and Googled it, and there was just zero information out there. So when you talk about it being real estate's best kept secret, especially for beginners, there isn't much information about it. And it is gate kept for a couple different reasons, which we can get into more. But essentially what it led to was I just kind of went down that rabbit hole regardless. And I took a lot of what she said to heart. She was a very successful woman who I looked up to immensely. And I just had it in the back of my head and spoke to a loan officer that I knew. He was about it. He said, listen, this is going to be a great thing for you. Ended up finding a literal crack house duplex. Even in New York, even with that low 3.5% down payment, I still could barely afford anything. New York being so expensive, the property taxes being so expensive. So I found literally a crack house that would also happen to be a duplex. And I learned on accident that one of the cool things with the FHA loans and the 203K loans as well is that you're able to buy a multifamily property up to 4 units. So you can occupy one of those units, rent out the others, and that other rent of the other units gets forecasted into your income. So it allows you to afford a higher loan amount, get a higher loan because they know that you're going to be getting some rent in the future. So the bank will give you a higher loan. So that gave me just enough money to purchase the house for $270 and get an $80,000 renovation budget. And I only had to pay $9,500 out of my pocket. That was it. Covering
just so I'm clear, just so everybody understands.
Yeah.
The FHA loan is the main loan for the mortgage, but the 203K is the mortgage or is the loan for the rehab, right?
Yeah, so they're two. I mean, FHA, the 203K is a version of an FHA loan. They're two separate loan products, but they all fall under the guise and the regulations of an FHA loan.
So they will lend you money, just so I'm clear on this, everybody
Yeah.
understands the power of this. They will lend you money for the rehab.
All of it, 100%. Yep.
That's insane.
It is very insane. And they give you all of it. All they ask for in return is 3.5% of the total purchase price plus the loan amount. They ask for 2 years of consistent, income, right? So it is a doc loan. It is a personal loan. You're not buying it under an LLC. You're living there, right? The reason the bank's giving you these amazing terms is because you're living there. Now, if you're watching this and you're listening and you're like, well, I already have a house, or I already have, I have multiple houses. This might not be exactly your loan. There's obviously other options too we could get more into, but there are other government products out there that are similar that allow you to do this. But at the end of the day, it's what helped me as a beginner just getting into it. Someone that's watching that maybe has one house but is willing to go into another house. It's not a first-time homebuyer program.
Yeah.
You just have to occupy it, right?
I have a couple questions here. Can you do it again a few years later?
So that's a great question. And up until November of last year, your only option really was to maybe not do it once, but FHA has a guideline where you're only allowed to have one under your name at any given time. Now, in my case, what I did was I basically did the BRRRR strategy, right? So I picked it up for $270, put $80 into it. My loan amount was for $350. Okay. I knew when I was done renovating, because I remember I had been learning about real estate for years up prior, like trying to wholesale. I was like, if I can get in at 80 cents on the dollar, all in of ARV, then this will be a great deal. I could build 20% of equity into it. Right. And that's exactly what I did. What ended up happening was I completely renovated it, was able to live in one unit, rented out the other unit. So my mortgage was essentially covered. I was maybe kicking in a couple $100 a month to live for free. But most importantly, I built $130,000 of equity into it to go buy more real estate. Now, what I did was I refinanced out of that FHA so that I could go and use it again. Now, I didn't. I went and I think, like I mentioned in the beginning, I went and started going into the flipping business because my background was in construction, kind of like yourself, and flipping seemed more natural to me with hard money and everything like that. But to answer your question, the FHA, you're only allowed one at any given time. Fannie Mae, who's also, a government-backed, government subsidized housing authority, housing bank, basically they came out with the fact that now you can also buy up to 4-unit properties, still with only 5% down, and you're allowed to have up to 11 of those under your name. So you can just keep repeating it and repeating it as long as you are willing to move into the next property, as long as you fulfill the guidelines for income, as long as you meet the income requirements, you're able to just keep doing this over and over and over again, which is really wild.
All right, cool. So my daughter, who's 13 years old, my kids know what I do. They know I'm into real estate. Mm-hmm. But just like most kids, they have zero interest in doing what their dad is doing until they're out on their own and they understand the value of a dollar and how much they have to work for just a little bit. And they see how much I'm making, doing what I'm doing, staying at home all day. They will come around. I know. I've done a lot of vacant land deals with my teenager boys.
I think it's so funny that you say that, not to cut you off, but I grew up around, a lot of friends of mine, some of which, immigrant families, and, they're maybe first generation or second generation or something. And it's crazy. And we're starting to see it. I'm kind of getting at the age where I'm seeing it come full circle, where I went to college with these guys and they went for engineering, and, but their parents built very successful, very amazing, impressive businesses because they came here with that immigrant hustler mentality, and they didn't have the opportunity to go to, American school and they didn't have the opportunity to go get professional degrees. But what's wild is they got the professional degree, they started working, and they're realizing that in order to get to where, the quality of life and the lifestyle that their parents gave for them, they're not doing it with engineering, or they're not doing it with, maybe like doctors or whatever. So, but now a lot of my friends are going back to kind of the family business and realizing many of which are real estate, and they're going back into the family business, which is I'm glad you brought that up, Joe. I think it's a very wild thing. And of course, again, I understand kids, everyone wants to be independent, and obviously my friends do too. And they don't want to do it, but it's very interesting.
Well,
but anyway, to your point about your daughter.
My 13-year-old daughter has now been talking to me, and she gets it sometimes a little better than the other kids. And she's like, I want to buy, she's telling us her goals. And when she turns 17, she wants to buy her first duplex. She wants to fix it up and rent it out. She doesn't want to live in it. But she wants to rent it out, use her profits to buy, then go to college, and then buy her own house while she's going to college, and then rent out the rooms to other girls, and get their parents to co-sign so that they're responsible for the repairs and paying the rent on time and all that. Like, where is she getting this from? This is so cool. But I'm wondering too, like, this could be a strategy that she uses in 4 or 5 years.
100%.
For buying a property in a college town that needs updating. But she would have to have 2 years of W-2 income to get one of these loans. Is that right?
So not necessarily. I mean, you can co-sign for her, there's, obviously the financing is there's always different options. One of the interesting things is that with FHA and these loan programs, they include your college education kind of as job experience. So this really more pertains to, like, maybe she's been a year out of college, or 6 months out of college or whatever, or not even out of college. She maybe just got her job out of college. Typically they don't go by just an offer letter. They want to see some trailing. But the exception to it is if they are, they graduated college and they're going into their career or whatever it is, they'll take the years of college experience and use that as the 2 years and give you the benefit of the doubt going into a new job. Obviously if she's doing it, not working yet, you can co-sign for her. And that's obviously an option there too.
All right, well, let's talk about some of the requirements for these kinds of loans. What are the income requirements, credit score, down payment? You talked about that a little bit already, but talk about income requirements.
Yeah. So income requirement, there is really no requirement, right? At the end of the day, they're just going to approve you on what your total income is versus your total debt, right? Your debt to income ratio, right? So it's usually about a 50% debt to income ratio is what they're going to lend you on, right? So that's take all of your gross income, right? It's gross income, whatever you get from your employer, right? And then you and then you divide that by your expenses that are revolving credit lines, your student loans, what your future mortgage payment would be, and they'll give you a max amount based on that. Now, again, the way to leverage this is to buy multifamily properties, or you can also, I don't know if you're familiar with ADUs or accessory dwelling units. It's becoming extremely popular in the US. It's a very hot topic right now. FHA and Fannie Mae also just changed their guidelines back in November to allow income from those accessory units, not even like legal separate units, but a mother-daughter suite, the downstairs. If you're able to get income from that, they'll forecast that to your debt to income ratio to raise your income to give you a higher loan amount capability. So that's the first thing. They approve you on a 50% debt to income ratio. Obviously, like, you have to be realistic about what area you shop in. But again, for me in New York, that's what gave me the boost to get approved for enough to afford my area. Because even with a decent job, making $80,000 a year, maybe at the time, it still was not enough to buy a house on my own in New York, especially a crack house. So that's the other thing. Credit score, 580 is minimum. Like, you should be higher than 580, but 580, they will still give you a loan. Typically you want to be in the 6s at least. And really that's pretty much it. The 2 years of consistent income and then occupying the property for at least a year after the closing date, or the intention to do so.
So again, you have to occupy the property for a year, but then after that you could refinance it, do that same loan again for another property, but you have to live in that for a year. So you could give an example of how you could maybe build your way up to, getting a really nice home for yourself, or free and clear properties. How to explain the BRRRR strategy and how this kind of can go on and on to build a bigger portfolio.
Yeah, absolutely. So one of my clients did this pretty exclusively. He had the ability to move around quite a bit. So in the first year, he actually bought a. This is an interesting one. He bought a fiveplex in Albany. Now FHA allows you to only buy up to 4 units, but it was able to get a 5 unit, convert it down to a 4 unit using the renovation loan, get it rezoned for the 4 unit. That fourth unit was a double size unit duplex that he was still able to fetch more rent for. So he ended up getting a monster deal out of it. Took it, built about 90 something thousand in equity, was cash flowing while living there. And then immediately moved out and bought a duplex down the road. And then just went on and continued to do that process. He's up to somewhere around 32 units now. And that's in a couple years. Now he did pour. Here's the thing. What this really does is it's opening the door to a lot more opportunity that this, Joe, right? Like the difference between the people that have done a deal and the people that haven't is like a massive gap, right? It's like this giant cliff that everyone's at the bottom trying to get up that cliff, right? But then when you get to the top of the cliff, like once you've done one, like the next one becomes a little easier and a little easier, right? But would you agree that like that gap is like the biggest? It's kind of for so many different reasons, right? Between financing, between self-confidence, between validity that like thinking that this is actually attainable. So what happened for him was like he did that first one and he was able to take that and he was able to use the equity, but also more importantly, the connections he built, the deal finding strategies that he built from like trying to do that. It's basically like, again, like flipping a house and doing a real estate deal with training wheels on because you're putting so little down. It's so little risk, so low interest rate compared to any other loan product that's an investor loan product. And it has a lot of fail safes built in to make sure that you're doing it the right way, that you can do it and then open all the doors for yourself and keep going. So that's what he did. And he was bringing on other house hacks. But what was also really cool about it was that while he's doing this, he was also leveraging himself into creative finance deals, into 100% financing deals, that he was able to build that reputation just from getting that first one, right? Yeah. Because when you get that first one, again, not only do you get the money from it and all the profit and all that good stuff, but you get the education from it, you get the skill set that you built, and you have the track record and a resume now. And that's really what I did. So in my case, what I did was I finished it out. I was able to take this deal. Now, when I did this first was 2016. Back in 2016, it's a little different than it is now. Like hard money lenders would not talk to newbies. Like they just wouldn't. I don't know if you remember this, right? Some of them out there will do it now. They'll say no experience. They'll do it. They'll kill it. They'll bang you over the head with fees. But they wouldn't talk to you unless you've done a deal. So to me, it was like, okay, hard money was out there, but it was never attainable for me. Once I did that deal, I just basically made a deal sheet. I gave a little track record about me, who my mentors were. I made like a little pamphlet and I was sending it out to hard money lenders. All of a sudden, they were giving me great rates. They were offering me money. I was getting private people coming to say they wanted to work with me, all of that one deal. I didn't feel deserving of any of it. But the reality was I got a good deal and I did a great job on it and they saw my returns. So it made me valid. So I was able to partner with a hard money lender immediately after, who gave me essentially 100% financing on my next flip that I did 6 months later. So in my case, I went into the flipping game because flipping was always what I desired to do because of my background in construction, my dad being in the business. Hindsight 2020, I wish I held a lot of those flips. But, at the end of the day, you live and learn. But essentially, it kept my money rolling for me. I got another rental property under my belt and really just kept moving on it to the point now where me and my wife are building our forever home right now. We picked it up for $615,000 off market. The renovation is being covered. They were doing a Fannie Mae home style renovation loan, which is pretty much the exact same thing as the 203K. It's just Fannie Mae's version. Doing all the renovation, probably about a $200,000, $300,000 renovation when we're done. The property is going to be worth probably 1.25, 1.3 when we're done. So we're building almost $500,000 of equity on this property. Again, practicing what I preach, using the bank's model. So over the years, it got me into flipping, built me some assets, but it's really cool to see the pinnacle of it now, like moving into our dream neighborhood with my 2 kids, building the house of our dreams where we wanted it. And it's really a culmination of doing this all through the renovation financing.
That's awesome. By the way, you're from New York, and I'm keep on waiting to hear your accent, your New York
I,
accent.
I shoot it in the back of the head every time I go on the podcast, and then it comes back. If I, family dinners and stuff like that, listen to my kids. It's hilarious. They have my son, he's 3 years old, and he's got more of a New York accent than I do. It's pretty
Now,
wild.
where
And
does
we
he
don't
get it
really-
from, though?
My mom, his aunts, his uncles, his grandma, his grandparents. My parents are strict Long Island, Brooklyn, New York accents. I've kind of, doing a lot of videos and stuff like that, I've gotten away from, and not because I'm not trying to be inauthentic, but it's just kind of evolved naturally over time. I'm not trying to get rid of it, but it depends on my environment. You know what I mean?
Yeah, if you're hanging out with people from New York, I imagine you turn it back on.
Oh, absolutely. Without a doubt. Yeah. It's like anything, right? Like, have you ever like gone away to, the islands or something like that, and you start to like have a little bit of a Jamaican accent, like you start bringing it on. Or
Yeah.
I remember when I was in London, I would like start trying to have the little bit of the British accent on things. Yeah. I think it's obviously who you're around, but it's a great point. People mention that all the time. It's funny.
Well, feel free to talk however you want to talk.
No. Yeah, of course. Yeah, absolutely.
All right. I want to ask you questions about, is there a minimum amount or a maximum amount that you can borrow for these loans?
Sure. Yeah. So the minimum loan amount, I actually don't know what the minimum is. Obviously, with the pricing of housing across the U.S., I don't think very rarely it's the minimum. But what the more important kind of way to answer the question is, what they give you the loan on is based on the purchase plus the reno, and it could be any combination of the two on the loan amount, right? So if you get a screaming deal and you buy a house for 50 grand. Or you could do this too. The only requirement is there with the 203K, with the renovation product, there just needs to be an existing structure of some kind. It could be just literally could be just a foundation. It can't be, you're the land guy. It can't be just land, but it can be existing structure, something like that. So any combination, like in my example, 50,000, you bought the house or the property for it, it's basically falling down, but you're putting 300,000 into it to essentially build a new house, then your loan amount is going to be 350, right? So the FHA loan limits are by county online. You could just Google it, FHA loan limits. They're significantly higher than most people usually expect. I know here in New York, the FHA loan limit for a single family home is somewhere about like 1.1, 1.2 million. And then if you buy a quadplex, it's somewhere in the neighborhood 2.4, 2.5 million. So yeah, it gets up there. It's usually, and it moves year by year. So it's been following the market pretty well.
Now, while you're renovating this property, you have to make payments on the entire loan amount, right?
Another great question and another great answer coming for you. So obviously they're aware that you're not going to be able to live and occupy a construction zone, right? So FHA and Fannie Mae have the option to build in up to the first 6 months mortgage payments into the loan.
Wow.
Now that goes to your principal, but for the people that are renting, and this happens all the time, people that are renting, they are like, okay, well, where am I going to live? Well, they don't expect for you to pay for two places, right? So it allows you to do up to 6 months. You can wrap those payments. That includes interest, insurance, everything, like interest, taxes, everything like that. It wraps all whatever your payment's going to be. They wrap back into the loan as many, and you could do it up to 6 months. They're actually making a change because, as a lot of people know, I'm doing my own home renovation right now. It's taking way more than 6 months. They know that a lot of renovations are typically taking longer than 6 months, depending on the scale of the renovation. So FHA just put it, I don't know if it's 100% pushed through yet, but it is coming, that they'll go up to 9 months now. Now, again, the thing to think about is it will increase your loan amount, right? It will increase it significantly. But in my case, for me, I knew that I wanted to wrap in as much as I could because I elected to do it because my tenants are paying down my mortgage, right? I still have that property. It cash flows me $2,000 a month, right? And I knew that, like, who cares? Like, my tenants are paying the mortgage. Like, if it kept more money in my pocket, why not?
The thing I love about this too is that you're renting out a newly rehabbed home. So it's going to be another 10, 15 years before you have to replace the roof or the water heater. And so you're going to get higher rents. You're going to get better quality tenants. We're going to get more applications so you can pre-screen your tenants better. You're going to have less maintenance and repairs. because it's a brand new property you're renting out. This is fantastic. Yeah.
You're 100% right. And that's why when I tell, again, it's flipping a house, it's landlording, it's owning a rental, all these things with training wheels on, right? I tell the people in my community, right? Like, obviously if they've come from, maybe they have they've seen some rental calculators out there, or, read some books or whatever. And they're like, well, what about CapEx and what about property management? And what I'm like, the beauty of this is like, you really don't have those expenses up front. Now, I'm not saying don't account for CapEx, but one of the things that holds people back so much is just getting so caught up in the numbers and getting so caught up in the analysis paralysis. I just like to tell people, like, just get your foot in the door with this. It's so little money out of pocket, 3.5% down. If you think of it this way, I think the average appreciation of the housing market over the last 50 years on an average is like somewhere around 4% a year over the last 50 years. You're literally making your money back in a year, even if everything goes wrong, right? So at the end of the day, you're putting so little out of pocket. Like, don't worry about the CapEx. Don't worry about stuff like that. You're building a brand new home. You're going to ideally be pretty good in the beginning. And, if you're house hacking, you're going to be living in the property and you're going to have the opportunity to kind of learn how to be a little bit of a landlord up front, up close and personal. And then when the time comes where you have multiple units, then start bringing property management on board. Like, I personally still manage my own properties. I don't see the need on property management for me, kind of where I'm at, but it's just good to kind of get your foot in the door and not have to worry about all those extra things that guys tell you to worry about, but like really aren't that important in the beginning when you're just starting out.
Yeah. Okay, cool. A couple more questions.
Yeah.
What could go wrong in something like this? What are some mistakes that people need to be aware of to avoid?
Yeah. So when I did mine, right, it was not rainbows and butterflies. Okay. So what I learned was with my lender, who, was I hats off to him. I don't think I would have done it if it wasn't for him and him specifically. He was a family friend. He was my cousin's best friend growing up. I knew him for years. He was the only loan officer I knew. And he gave me the confidence to do this 203K because, like I mentioned, there was no information on it out there. So I went with him because he was the only person I trusted. He was a family friend. And I knew that, like, worst could go wrong. Like, he knows us and he's not going to do bad by me. What I learned very quickly is that him nor anybody in his office had ever done one of these before. So we kind of got in the weeds on this and realized that, like, nobody knew what to do. And it was just paperwork flying everywhere. And that's the common thing you'll hear. You'll hear from really, like what I was mentioned in the beginning. Why is it the best kept secret? Lenders and real estate agents don't want people to know about it because to them it's more work. Because they've had a horror story about it or they don't understand it. And because what do people do to things they don't understand? They either avoid it or throw rocks at it or make fun of it, right? So that's what's been happening. And that's fine. And I'm okay with that because that's what makes it special to me. Because for the people that actually take the time to learn it and understand it, you just said yourself, like, it's insanely powerful. This product is with great power comes great responsibility. So yeah, when you're responsible with it, you know what you're doing, it's huge, it's paramount. So to my point, though, I realized that they had no idea what they were doing from the lender side. Now, if your lender doesn't know what you're doing, nobody else is going to know what they're doing. They're kind of quarterbacking the process. So number one, you have to work with a deeply experienced lender, right? Shameless plug. I've been able to network with the best lenders in the country that do this, that specialize in it. The 203kway.com/lender. Fill out a form and it'll just kind of we'll introduce you to a lender that services your market. But at the end of the day, whether you use someone through there or whatever, just make sure that this lender absolutely knows what they're doing. They're very experienced. Not, oh, yeah, someone in my office did it before. Like, it's like anything else. You want to make sure that I always make the analogy. If you have a Porsche and you want to get your oil changed, you don't bring it to a Honda dealer, right? You're going to bring it to a Porsche dealer because you don't want to take the risk on your Porsche. Now, the Honda dealer might be able to do it, but do you really want to do you want to find out the hard way? No, you want to go with someone that does these. There's lenders out there that specialize in these. They know this game. That's really one of the biggest things. The other things obviously they come down the path of that, but that's why the lenders, that's such the foundation, because they're going to help you get the other talent that's needed for the process, right? So the two other people that you need on your team are a 203K consultant. Essentially, they're home inspectors. They're usually always home inspectors also, but also do 203K consultants. What the 203K consultant does is they'll go in, inspect the property, and then they'll also, and based on what's damaged or there's issues with, they'll create a scope of work of what needs to be repaired. They'll also work with you personally to ask what you want done to the property in addition to the repairs. So, right. So there's really no limit on what you can do. It's pretty much, anything that's integral to the property you can do, right? There's no limit on like how fancy your finishes could be, as long as you can afford it in your budget for your loan. But they'll go in, they'll create your scope of work. Once they create that scope of work, then you're a construction guy, build the scope of work first, then shop it out to the contractors. And that's where, again, a lot of people I see making a big mistake. I have a background in construction. If you remember this, called leveling the bid, right? They do an RFP. Like, this is how big construction goes. So this is why small construction should also go like this. There's no reason why this is like not part of that rule. This is the way that we make sure that all the contractors are bidding apples to apples, that there's no loss in communication, that everything's very clear and line itemed and scoped out. And that way you can also negotiate better to get better pricing from your contractors. So those are really the key main points. Those are the ways it could go wrong, but those are also the antidotes on how you can make them go right.
So for the construction, do you recommend getting one GC to manage it all, or what do you sub out?
So the contract, so you have to hire a contractor, and it's the contractor's responsibility to do the subbing and everything like that.
Okay.
They don't want you to act as the GC on the project. Now, some banks will do it if you're deeply experienced with it and you can prove it, but typically you just want to use a general contractor, right? So what I did in my case, obviously I have the background in construction. What I did was, we had family friends and friends in the business. So like, we had them as our contractor. And, we knew we had a little more control because we knew what we were doing. But newbies mess this up all the time. They think that they can GC their own project, or they could do it themselves or whatever. And I mean, listen, I know construction. I've been in the industry for as long as I've been able to swing a hammer. I still don't do any of my own work, really. I mean, very rarely. I don't. I would much rather the professional tile my bathroom in 2 days than it take me 2.5 weeks. So, but yeah, you have to hire a GC, licensed and insured. That's all they require. Common misconception is you need a 203K certified contractor. There's no such thing. HUD does not certify contractors. There's no certified HUD contractor list. But the bank needs the documentation just stating that they're legit, they have licenses, they're insured, they have experience, that type of thing. That's
so when you apply for the loan, you need to give them a contractor's estimate for the repairs, right?
Absolutely. So what happens is, again, the best course of action for it is you look for a house, you find a house, you get under contract. Once you get under contract, the first person that should go in there is your 203K consultant, because that consultant is going to inspect the property to see everything that needs to be done by code standards, by FHA guidelines, everything like that, just to make it up to snuff. And they're going to create that scope of work alongside you so that you can now take that scope of work and bid it out and give it to the contractors. I mean, I'm doing my own house right now. I have subcontractors that I've used for 15 years. My dad has used for 15 years. I still didn't give them the job. I thought they for sure would have gotten the job. I ended up going with other guys because the pricing just wasn't there, or they were busy, or whatever it is. So always I say minimum 3 other bids. 3 to 5 is what you look for. So get 3 to 5 bids, compare apples to apples. And then when the contractor gives their number, that estimate will get paired in with that scope of work. They call it an SOR, a schedule of repairs is what they call it. They put that with the scope of work. That gets submitted to the bank. Then the bank gets ready, they close, and then at closing table, the seller gets the money for the purchase, right? And then the remaining budget, plus they automatically tack on a 10% contingency no matter what.
I was going to ask about that.
Yep, and it will go up to 15% if it's a much heavier rehab. So, but they'll do that, and they put all of that money into an escrow account. Now, just like hard money, just like a hard money loan, something like that, what happens is as you go through the process, they'll draw down, and the 203K consultant then becomes the draw specialist. So the draw specialist will go out there, inspect the property, see what's been done, and the contractor gets paid, and it gets direct, either direct deposit to them or check to them. And it's really the 203K consultants essentially like the referee, right? Being in the construction business, I can't tell you how many times my dad would come home all upset because a customer's holding 20 grand back from him because they didn't get the hardware for the cabinets. And it's like, listen, the hardware is a couple $100. Why are you holding back 20 grand? But they'd use that as leverage. With this, it's very black and white. Here's what you're paid for. Here's what you've done. And they'll give you percentages of it. Hey, the kitchen's half done. We'll give you half the money for the kitchen.
Nice. Yeah, this sounds like an amazing opportunity for a lot of people here listening to this. I wish I would have known about this a long time ago. Cool. And just so I'm clear again, there are FHA limits. And so you need to look into, just Google FHA limits. Mm-hmm. And depending on where you live, I think in St. Louis, Missouri, last I looked, I'll have to look right now. It was $400,000 or $500,000.
Yeah, it sounds probably about right. Obviously, the higher cost of living areas get a little bit of a boost. Like me being in New York,
$498,000 in St. Louis, Missouri. Mm-hmm. $500,000. That could get you a really, really nice house. Okay, cool. So, Matt, why are you talking about this? I mean, what's in it for you? What do you sell? What do you do?
Why am I talking about this? It's a great question. Well, the reason I'm talking about it is because I remember finally being done with the 203K and literally getting the last inspection, getting the certificate of occupancy after the years of trying to get into real estate, smelling the paint on the walls, seeing the new floor, and being emotional. Honestly, I was like, it's been like, since I remember thinking back to the journey of like when I bought that Rich Dad Poor Dad book to when I finished that was years. And what was wild to me was in all those years, never once did anybody talk about this loan. And even through all the BS that I dealt with on the loan myself, like I had to figure it out on my own, which it taught me a lot about it. I just didn't understand why more people don't know about it. Right. So essentially what ended up happening was I became very very active on Bigger Pockets and stuff like that. And people were always asking me because, again, they hear about this product like through the grapevine. And to your point, like it sounds great. They wish they would have known about it sooner. But there's no information about it. So, and I know it's because that lenders and real estate agents, they gatekeep it. And I understand why they do it. But I am not an agent. I'm not a lender. I'm just a guy that used it, had it completely change the trajectory of my life. And I want more people to know about it. So, to answer like what I do, what I sell, I mean, I don't, I have a community called the 203K Way. I have a Facebook group. I post every day on social media on just tips on how to do it. For me, the first thing is awareness. On the back end, of course, I've been able to create relationships, and I have people that are like, hey, Matt, I just want to do it right the first time. And I help them with the implementation of it. I build them their team. I help them find the deals. I help them walk them through it because I did find a need there. That's available to people too. But, I like to say that I give all the information I can on this on YouTube, Instagram, everything like that. If people want to work with me to make sure we slam dunk it for them, that's an option too. But it turned into this kind of holistic thing where for me, it's just a movement to try to get more millennials into home ownership, get them into real estate investing, and do it with very little out of pocket.
Looking at your website, the 203. I was the 203K Way.
Yeah, the government likes the numbers and the Ks. I don't know why, but they have a 203B loan. It's completely different than the 203K. But yeah. The 203kway.com.
I love it. You've got a book, it looks like, here too.
Yeah, a little PDF kind of telling you a little bit more about my story, kind of how I found my deal, how I underwrite the deals, how I refinanced and all that good stuff. Got that. Again, the best place I think is probably my Facebook community. That's free. Just look up the 203K Way. And I do live trainings on there every week. Again, my biggest thing is just awareness. I just want more people to know about it. It's insane to me how many people don't even know this exists.
Yeah. Well, this is cool, Matt. I'm glad that you are here. You have a cheat sheet as well that you give away on your website. What is that? So what's on that cheat sheet there?
Yep. So it's basically just a breakdown again of a little more in depth on like step by step what to do, the process. Again, like the other thing too, since there's just no information about it, so like people don't like even real estate agents and lenders that should know about it, they don't even know like the order of operations and what things should be done in. So that's another thing there too. Just all more, little things here and there that just give people a little bit of an edge when they go into this.
Yeah, this cheat sheet looks really cool. How to find properties to buy, renovate, and live mortgage free, and create massive equity in 4 steps with little out of pocket. I love it.
That's it.
Cool. And then people get a hold of you, are you mainly Facebook group or?
Facebook group. My Instagram is probably my main place. The 203K way, at the 203K way on Instagram. If you just look up 203K on there, you'll find me. I answer all my DMs. It's me personally. It's not there's some automations and stuff. If it sounds body, it probably is, and you'll know it. But I will always contact you and, tell me you heard me on Joe's show, and I'm happy to help.
Awesome. Well, go check it out. Again, Matt's website, guys, is the 401k way.
The 203K way. We have the 401k so ingrained into our skulls.
You should buy that domain, by the way, the 401k.
The 401kway.com.
Yeah.
Well, listen, you can use your funds from your 401k to buy your 203k property, and I'm a big proponent of that because the 401k is not doing jack for you compared to what a 203k would do.
Yeah. So the 203kway.com, or just look up Matt on IG at the 203K way on IG. Matt, thanks for being on the show, man. I appreciate it.
Thanks for
having me.
Look forward
to talking again sometime soon.
Absolutely. Thanks, Joe. Appreciate it.
We'll see you all later.